Hey guys, what's going on? Robert Montez here with more tips to help you win with money. On my channel, what I do is I take questions that I get from my clients as an investment advisor representative, and I bring those questions to you guys via video with the answers to hopefully help you be a more informed investor, make better decisions because you have more facts, and help you win with money. With that, what I wanted to do is get into the question of what is a Morningstar style box, and why is it important to you with your investment selection? So with that, let's get into it. Any of you guys that have ever met with your advisor or maybe just looked at a mutual fund that you own have probably seen something like this, which is a Morningstar Equity Style Box. Now, if no one's ever explained what this is to you, it can be a little confusing. So that's why I wanted to start here and just kind of explain what does this mean and how does it affect you. What you'll notice first off is that we have a 9-square box with value, blend, and growth on the bottom, and then large, mid, and small towards the right-hand side. We also have some numbers in here. As you can see, these numbers are all spread out, and I want to start with that. What do these numbers mean? Well, these numbers represent a percentage of how many of the stocks that are in your portfolio are in this style of business. So what I mean by that is if you were to look at all these and add them up, all these boxes add up to 100. So for example, here in the large growth section, 40% of the stocks represented in the portfolio are large growth style stocks. 3% of the businesses are mid-sized value stocks. So that gives you an idea of where your assets are at and in what type of different companies. Moving to the next part, what is this whole value, blend, and growth, and then large, mid, and small? What does that mean? Well, value, blend, and growth tells you the style of business that you are investing in. Let me give you an example. A value stock is a stock that is typically trading for less than what its fair market value is deemed to be. Easy way to understand that. Imagine you have XYZ Incorporated, and XYZ stock is trading for $35 per share. And you as the individual or the fund analyst, they go out there and they look and they say, you know what, XYZ stock is only trading for $35. But when we look at their books, their revenue, their property, everything that brings value to their company, everything shows that this company is worth $400 million. And there's only 10 million shares of XYZ stock out there. So simple math, 400 million divided total market cap divided by 10 million shares that are existing tells us that the shares should be trading for $40 per share. But as we were discussing earlier, if they're only trading for $35 per share, that's a $5 difference that people haven't realized is there. It's so that the stock is selling at a value-based price. It's a good buy. Now, people ask, well, what causes that? Lots of things. It could be that XYZ Incorporated just isn't a very popular business model, or maybe they're doing something that hasn't really gotten the recognition or become commonplace in our society, and so it's just trading for less than what it should be. But what a value-based investor will do is buy that with the intention of holding on to it long-term with the idea that eventually the market is going to understand that XYZ is worth $40 per share or more, and at that point, that's how they capitalize on their investments long-term. In addition, value-based stocks are typically paying dividends. So a dividend, as a reminder, is when a company is sharing their profits with you as the shareholder. So think of it this way. If I own Robert's Pizza Shop, even though, and maybe I came to you and said, hey, I'm looking for investors, and you said, you know what, Rob, I believe in your pizza. Here's 5% of what you need, and I'll give it to you as an investment into the business. Even though you have nothing to do with running the pizza shop, you would still expect to share in the profits relative to how much you'd invested, and that would be essentially a dividend. I'm sharing the profits with you. So sometimes you'll hear things about dividend payout rate. All that is that, for example, if a company was selling for $100 per share, but they pay $5 in dividends per share, that would be 5%, a 5% dividend payout that they're paying on a yearly basis. So value stocks, again, typically selling for less than what their fair market value is and typically paying dividends. Growth-based stocks, on the other hand, are going to be stocks that are growing their profits faster than other companies, either in their industry or even as the market as a whole. So an easy example is think of a hot technology stock. Well, if you have this brand new, sexy, sleek technology that everyone's using and everyone sees themselves using, for the foreseeable future, you might say, hey, I know this is expensive. You know, the books don't show that it should be selling for $100 yet, but man, there's so much potential. I'm going to go out and I'm going to buy this stock at $100 per share, with the idea being that as this technology continues to grow, the business is going to reinvest back into itself, and the shares might go from being worth $100 per share to $200 per share. So there's a huge potential for capital gains. It's kind of like buying something. Maybe you're buying a piece of property that you don't think right now is you're spending a lot, but hey, this has the huge potential because of the location, and they're building a mall right down the street, and this is going to be a hot spot for years to come. That's the idea with a growth-based stock, is you're buying based on the idea that it should continue to grow, and that's what you're betting on. Now, historically, growth stocks have the potential for making more money than value-based stocks as far as their capital gains, but they're also more risky. So that's something to take into effect. Remember, risk is, if you're taking more risk, you should always be getting potentially more return. So keep that in mind. The last thing we're going to talk about here is, what does it mean by large, mid, and small, and then how does that affect your portfolio? Well, this talks to you about the market capitalization of a company. What I mean by that is, if you were to take all the shares of a company and add them all up, what would the company sell for? So a small base company, a small cap company, is going to be a company that is worth $250 million up to $1 billion. A mid-cap business is going to be a business that is selling from that is worth $1 billion up to $10 billion. And a large cap business is going to be a business that is worth $10 billion and above. Now, bringing all this together, and why does it affect you? Well, this really has to do with diversification and knowing that you have assets in different styles of businesses. Why is this important? Well, a large value business is going to react differently to the market than a small growth business. Think of this, for example. If you have a large, well-established company that is paying consistent dividends over time, it's probably not going to hit that bell curve growth, but it's going to be stable. So you're taking less risk, maybe earning less money, but it might be a little bit more stable than something that's more on the growth side. A small growth company could be an up-and-coming business that might be the next Amazon, the next Microsoft, the next whatever, where there's an opportunity to buy it now while it's a small company, with the idea that it's going to grow substantially over time. And so that's why people will use this box to understand what their assets are in, how that affects their diversification, and get a bird's eye view of the different asset classes they're using. The last thing we didn't talk about was, what does blend mean? Blend is a blend, all right? Blend means it has some of the characteristics of a value-based stock, some of the characteristics of a growth-based stock, and it's kind of a hodgepodge of the two. With that, guys, hopefully that answers the question of what is a Morningstar Equity Style Box, as well as gives you an idea of how you can use that to understand what your portfolio looks like as a whole. As you noticed in that example, that one had zeros all across the small cap businesses. So if someone was looking for a truly diversified portfolio that had investments in all different style boxes, might not be the best fit. But again, that's why it's important to do your research, important to have all the data. As always, talk to your financial professional. If you're going to consider making any crazy changes as off a video that you see on YouTube, do your research. You'll make better decisions. If you haven't, please hit that subscribe button. Go ahead and hit the notifications, because we all know that subscribing doesn't really do much anymore today. But you'll see videos on a week-by-week basis where I am giving you tips, again, on winning with money and investments, real estate, a lot of different avenues that I get questions on. Excited to share those with you, and look forward to seeing what you guys have to say in the comments. Thank you so much. Enjoy your day, and make it a great one.